Hello, welcome to easyaccountingonline.com. My name is Anna John. First of all, congratulations for taking up this course. Whether you are new to accounting or you already have been into accounting, this course is going to help you a lot. This is a beautifully and carefully designed course to teach people accounting easily from scratch to all the levels and help people to practice accounting in order to widen and strengthen their career. This course will train you for the complete accounting process with step-by-step effective techniques. If you are looking for a new career in accounting or an advancement in your current accounting career, this is going to work a great deal for you. Or if you are a business or commerce student, you can explore and get total grip of accounting with this tutorial. If you are currently in a managerial position and want to understand accounting to control the business, this will definitely meet with your requirements. No doubt, this course will prove to be a most effective and highly rewarding one for you. So we want you to feel confident and we are with you until you master this totally, whether it's for your career advancement or education purpose. So feel proud of yourself for having chosen us to train you. Please fasten your seatbelt as we are going to take off.
Why accounting? Accounting is one of the most demanded and highly respected professions because of its very nature itself. All business, right from small grocery shops to big multinational companies, are functioning for making profit. Profit is measured in terms of money. Accountants are the custodians of money. They are the ones who handle it, record it, and report the results of the business in the form of financial statements. Job for accounting people have minimum guarantee in any economy and under any economical conditions. There are many levels for accounting jobs like bookkeeper, accounting clerk, accountant, senior accountant, chief accountant, auditor, internal auditor, finance manager, financial analyst, finance director, and so on. It is very easy to move from one level to another one according to the knowledge upgradation and experience. Having accounting knowledge makes it easy to move to the managerial positions. It is worth noticing that the CEO and presidents of the most of the world-renowned companies and corporations are from accounting background. And so is the case with small and middle-sized companies also in general. Accounting is very easy if you don't make it complicated by yourself.
Many people have misunderstood that accounting is very difficult and is consisting of lots of mathematics. But you will be surprised to know that accounting has no mathematics except addition and subtraction, and in some cases multiplication and division also. Accounting is all about categorizing the items and applying a few rules in deciding on expenses and revenues. So if you have any misconception on this, please change it now before we start.
Accounting is so simple to this extent. Profit is revenues, that is sales, less expenses. That is profit. Yes, you believe it or not, it's true.
Then the question is, why is it considered difficult? What is the need for accountants in organizations? What are they paid the handsome salary for? What are they doing all the time sitting in front of computers, scrutinizing, checking and rechecking their long spreadsheets? What is all this drama about? The answer is, even though the equation is very simple as profit equals revenues less expenses, it may grow difficult depending upon the size and activities of the business.
For example, at the time of calculating the profit, there could be some sales which already have been done but cash not received fully. Some customers might have paid in advance but goods not delivered to them, while some other customers are yet to pay, etc. Again, we might have bought some items, but payment to the suppliers might have been made partially only. Some materials we had ordered may be still on the way on the truck. Many jobs may be still ongoing in the site or in the factory, and equipments bought might be used for different jobs and will continue to be used for some years to come. Many jobs may be almost finished, but invoice is not issued to the customers. Invoicing is the process of claiming the money from the clients for the services done or goods supplied. Some goods and supplies we had bought for the job might be still in the stock unutilized.
In this scenario, how shall we find out the profit or loss of the business? It seems a bit tricky here, doesn't it? Well, how we will work out the profit or loss is depending on applying some rules and categorizing the expenses and properties and presenting in the form of financial statements. This is done as per GAAP, that is, generally accepted accounting principles, which are universally accepted and practiced. All accountants in every part of the world are doing the accounting based on these principles. We are going to study them. So please get ready, we are going to start exploring it. Please feel interested and remain excited.
Getting familiar with accounting terms. The accounting terms we study below are going to be a part of your life once you are associated with the accounting field. So please be well versed with these terms. 1. Revenues. Revenues are the income from the normal operating activities of the business. Usually, the companies receive revenues from the sales of goods and providing services to its customers. A manufacturing company's revenues will be from sales of goods to its customers. A lawyer firm's revenue will be the fees collected from their clients for services provided. A laundry firm's revenue will be the fees collected from its clients for washing and ironing the clothes for its customers, and so on. In short, revenues are income from the sales of goods or providing services in which the company is dealing in. In some cases, the revenue is called turnover also. The firms may also receive revenues from interest, dividends, rent from subletting a part of the office space, etc. The revenue is the most important item in the income statement, which we are going to study in a short while. This item is always taking the first place in income statement or profit and loss account. Number 2. Expenses. Expenses are the cost of services used for earning revenue or the cost of assets used during the earning process. All spending incurred for the process of company's income generating activities is called expenses. The below are some general expenses that normally incur. 1. Salary. Salary paid for the staff. 2. Rent. Rent paid for office buildings. 3. Transportation charges. Payment made for transporting services of materials, goods, etc. 4. Printing and stationeries. Charges paid for office stationery items and printing materials. 5. Advertising expenses. Charges incurred for advertising and promotion of the company. 6. Bank charges. Charges incurred in the bank for bank services like wire transfer to the suppliers, checkbook issuance charges, check collection charges, etc. 7. Office store supplies. Cost of the office consumables purchased. 8. Repair and maintenance. Charges incurred for repairing and maintaining the office and business premises. 9. Electricity charges. Charges incurred for using electricity in office, factory, workshop, etc. 10. Telephone charges. Charges incurred for using telephone, internet, fax, etc. 11. Insurance expenses. Cost incurred for insuring the office, staff, machinery, buildings, etc. Depreciation. Depreciation is the gradual decrease in the value of the assets due to usage and passage of time, wear and tear, being obsolete, etc.
Let us look at the depreciation in a little more detail. The depreciation is a very important aspect that you should be very clear about. Suppose you bought a new Lexus car today for $35,000 and enjoyed driving it for 4 years. After 4 years of using it, you decided to sell the car. How much would you expect to be paid for that used car of yours? Will you be getting $35,000 which you had paid 4 years back? It is of common sense to understand that you will not get that money. You may get, say, $20,000. Then what is the difference amount gone? Yes, that is depreciation. So depreciation is the gradual decrease in the value of the assets due to usage and passage of time, wear and tear, being obsolete, etc. In accounting, we have to calculate how much will be the yearly depreciation, that is, decrease in the value of the asset, for each asset and record it as expense. So simple, isn't it? We'll study how to calculate the depreciation at a later stage. Depreciation is shown as one of the expenses in the financial statements.
3. Assets. Assets are what you own. They are those which are in your possession. Assets are properties or anything in value which can be owned by a company or enterprises and can be converted into cash. Examples for assets are cash, stock, that is inventory, debtors, that is those who have to pay to the company, vehicles, land, equipments, securities, etc. These are the properties or anything in value which are used for running business and can be converted to cash. Assets are again classified into two as fixed assets, current assets. Fixed assets are those which are used in business on long-term basis for a continued period of time and cannot be easily converted into cash compared to current assets. The examples are land and building, plant and machinery, vehicles, equipments, furniture, fixtures and fittings, etc. The liquidity, that is the possibility and easiness to convert into cash, is less for fixed assets. Current assets are those which can be either converted into cash easily or can be used for paying off current liabilities. The liquidity is more for current assets and can be easily converted into cash. The examples are cash, bank accounts, bills receivables, debtors, stock or inventory, etc. The liquidity is more for current assets. The most liquid asset is cash itself. 4. Liabilities. Liabilities are just opposite to assets. Liabilities are those which you owe to others. Liabilities are the company's obligation to pay to outsiders. Bank loans, bank overdrafts, creditors, that is those whom the company has to pay to. Bills receivables, etc. are the examples of liabilities. Like that of assets, liabilities are also classified into two: long-term liabilities and current liabilities. Long-term liabilities are the long-term obligation of the company which are to be paid after 1 year, that is operating cycle. Examples are debentures, mortgage loans, long-term bank loans, notes payable, etc. Current liabilities are those obligations of the company which are to be paid or settled in short term, that is normally within a year. Examples for current liabilities are short-term bank loans, creditors, that is those to whom the company has to pay to, bank overdraft, outstanding salaries, outstanding expenses, etc.
Now we are going to another most important terminology and aspect of the accounting. Please understand this clearly. This is very important and worth learning.
Owner's equity.
Equity means ownership. Owner's equity is the owner's investment in the business. All business can be started by putting in some money by the owners in form of cash or amount in the bank. This is called capital or owner's equity. This is the initial step while starting a business. Please note that in case of sole proprietorship and partnership business, owners or partners' capital is the owner's equity.
At the start of the business, the owner or owners will bring in cash for the commencement and the operation of the business, which is called capital. Initially, this will be the initial owner's equity. Later on, they may bring in more cash if required, and it will be added to owner's equity. Again, if there is a profit at the end of the year, which will come from income statement or otherwise called profit and loss account as its final output, the net income arriving from it will be added to owner's equity. There can be drawings by the owners during the year. Drawings are the withdrawals from the business for the personal use of the owners. The drawings will be deducted from this. See the net figure. that is the closing balance of owner's equity for the period entered. If you put this in the form of a statement, this becomes the statement of owner's equity for the period entered. Statement of owner's equity is the second financial statement that we get after closing the accounts, which we will study in detail at a later stage. In short, owner's equity is the amount that owners put in the business in the beginning, additional investment that they bring in later on, and the profit from the business being added to this minus drawings. Account. An account is an accounting device used to record increase and decrease in an accounting item. In other words, it's a page in a ledger book with two sides for amounts, left side being debit and right side being credit. The both sides will be used to show increase and decrease in an item. For each type of expense, income, asset and liability, there will be an account.
This is all you have to understand at this stage. We will detail and work out this later while doing the accounting entries for all transactions right from starting of the business. You have to remember that owner's equity is the liability for the company because it is like the amount that the company is borrowing from the owners, and the company has to return this amount to the owners at the time of closing down the business. So remember, owner's equity is a kind of liability for the business. Now you have got an overall knowledge about the common terms in accounting process, which will be widely used in the upcoming chapters and accounting process. We are finishing the chapter 1, and I'm pretty confident that you have understood the simple narration of the basics of accounting. Please go through it again if you are not clear before we move on to the next chapter. You have to go to the exercise session and do the practice by answering the questions. Get prepared for the next chapter. Wish you good luck.